Alright, in this video I'm going to break down a recent short trade for you where I had two interesting technical elements lining up, an ascending channel and a moving average confluence. See, the thing is, whenever I spot such a confluence with an ascending channel forming and a key moving average like the 9 EMA catching up and flattening out, that's almost an A+ reversal setup that I certainly like to play. To say that these are the types of high probability entries that really pique my interest would be an understatement. So zooming in on this 5-minute ES chart, we can see that during this accumulation phase here, the market actually printed a new structural low down here. But get this, every time price came into this level, the buyers were stepping up, sending their bids on the order book as they were trying to soak up some of the sell side pressure and keep this level supported. Also, judging by the intensity of this spike, this shakeout down here was, in my view, a textbook Wyckoff move playing out. For those new to trading, these shakeout moves usually happen towards the end of a trading range. It's when the smart money players need to do one final supply check before they can flip the switch and start reversing the market to the upside. Now, how that works is that if the amount of sell orders when we break that support is very thin, like the lightweight supply we see here, that's the green light that the path of least resistance is now up. What that means is that the sellers are basically tapped out at this point. Once that selling pressure is exhausted, an automatic rally phase kicks in, and then we see price surge up aggressively as big players start actively marking up their positions. Now the low from this selling level down here and the high of this rally up top, now these 2 points obviously set the initial price levels for a new trading range in the short term. Also, if you notice, as the market starts spiking, it forms a 10-point imbalance zone here, plotted just below the 66 level. After that, we see the price starting to lose steam and reverse around the 52.80 area as the supply side re-enters the market, capping this whole bullish surge. The market retraces, however, from early losses as bulls try to retest the high of the range. But despite this bullish attempt to push through, the price strongly, as you can see, gravitates down towards this imbalance zone we identified earlier, printing something like 6 points lower from the previous low. And speaking of imbalances, it's like there is just this magnetic pull from this area of untapped liquidity dragging prices lower. The fact is that, and if you really think about it, the markets have this tendency to sort of shift direction or react at those price points where supply and demand are really out of whack or out of balance. What I mean is that when you've got a major imbalance zone like this one stacked up at a key price level, that's usually when you can expect to see some strong price movements kick in. So after this strong supply bar capped the retracement, the bulls tried to muster up another push higher. But they just didn't have enough ammo left to seriously challenge, let alone bust through these range highs here. The lack of momentum to push higher was clearly my first confirmation that the bullish trend was running out of gas and exhausting itself. That's when this ascending channel started carving out. What that tells me is that now I have spotted an area of interest, and within that area of interest, I need to identify a legitimate reversal trigger. And that legitimate trigger should be something that can actually open up an entry point so that I can position myself to catch the turn to the downside. And on a separate note here, guys, I know that conventionally an ascending channel is viewed as a continuation pattern, not necessarily a reversal trigger. And I get that. However, from my experience over the years, I found that questioning the conventional wisdom can often expose flaws or blind spots. More importantly, being analytically inquisitive opens up, in my view, opportunities you might have missed if you didn't challenge those traditional ideas. The way I see it, An ascending channel, especially when it forms within a distribution phase, like we have here, an ascending channel can absolutely serve as a bridge or connector pattern, if you will, between a mini uptrend and a downtrend. It can actually be a signal that momentum is stalling and the market is getting ready to shift or reverse. The idea here is that rather than just going with a textbook definition, I choose to let the price action and my analysis of the overall context guide me. Keep in mind, guys, that when you do your own trade analysis, if all the other technical factors are lining up for a potential reversal, don't ignore a pattern. Don't ignore it just because it goes against what's considered normal. I've learned that those unconventional times are when you can really find an edge. So my game plan here is simple, to short the market by setting my entry just under the channel's support line. More specifically, my thinking was with buyer momentum fading and that imbalance area sitting below, I was counting on price to bleed through the 9 EMA and possibly then crack that channel support with a confirming close bar. If both of these support levels lined up with a breakdown, that for me was going to be the green light for this thing to really tank hard. In fact, such big imbalances, not always, but often, tend to get resolved rapidly when triggered. Now, another thing that I want to highlight here is that if the ascending channel hadn't broken support and confirmed, and this is important, and confirmed the breakthrough a closed bar below, the entire scenario unfolding up to this point with this channel's sequence of higher lows would have been classified in my view as a continuation pattern, meaning that this would have indicated to me that the market's bias in the short term was higher. However, the uncertainty before that support getting broken had me questioning whether the price would continue its upward trajectory or make a move to the downside. Situations like this, especially as I mentioned within a distribution phase, trigger what I term as the RMPDP function, which stands for the market's reassessment of its price delivery process. This process is basically the market's way of telling us that it's trying to reach a decision on its directional bias. In my opinion, the determination for you as a trader of which direction the market will take relies strictly on filters or confirmations. In this trade, these are represented by establishing a trading range, determining trend direction, identifying pattern continuation, reversal triggers, and considering all the technical factors and confluence I highlighted during this analysis before pulling the trigger. And as you can see from the price action here, the approach and entry point proved correct as the market's bias was to the downside. After getting filled, price immediately starts stepping lower, but then out of the blue, the market elevator goes into free fall mode here. I mean, it just completely nosedived, and obviously way below my initial profit targets once we cracked that imbalance zone. And guys, if you're looking to improve your trading and get better results, this checklist video will provide you with some extra tips necessary, I think, to do just that. Alright gang, as always, thanks for watching and hope to catch you all in the next one.